let's take a look at how to analyze financial statements. When we're looking at analyzing financial statements, we are mainly based on three aspects: liquidity, profitability, and leverage. Liquidity is about cash, having enough cash to pay the bills. And our statement of cash flows will show us a lot about cash, how the cash is being received, where's it coming from, how are we spending it. Also, we can look on the balance sheet, our current assets and our current liabilities, and see if we have liquidity there. We have various ratios that we can calculate to see if we have enough liquidity. This is the number 2 goal of every business. Profitability is the number 1 goal of every business, and that means to have more revenues than expenses, to have net income as opposed to net losses. And so if management can't attain profitability, the company is going to go under. So every company has some years that are not profitable, but for the most part, we are wanting the business to be profitable and to increase owner's equity. And leverage talks about comparing the amount of debt and liabilities compared to the equity that's in there. So if we have 2 companies and one has 90% in debt and 10% in equity, and the other one has 10% in debt and 90% in equity, we would want to invest in the second one. Or if you're a loan officer at a bank, you're going to give a loan to the second one, the one with the lower debt and more in equity. So we look at various ratios regarding leverage as well. As far as how we can compare things, we can compare one or more previous periods. So if you're looking at General Motors for one of your companies, you can look at, say, the last 5 years and see what kind of trends are happening. You can look at data for the industry as a whole. So if you're looking at General Motors, you can compare it to the car industry averages. Now, the problem with that one is that to get this data, you need to pay for it. We at OC Tech do not have ability to look at that. So, but if you were Edward Jones or some other investment brokerage, you would pay to have that kind of data available. You might want to compare Ford to other businesses in the industry, and any business that is public business, so the public can invest in it, then their information, their financial statements and stuff is publicly available. Okay, you wouldn't be able to compare GM to some private business, private car company that's not available for the public to invest in. And we can compare our actual numbers to preset plans or goals. So we might have our budget, say, that shows that we want to have sales of this much and cost of goods sold of that much, and how do our actual numbers compare to that budget. Maybe we have goals that we're gonna the inventory turnover, we want that to turn over more often, and so we're going to work on that or something. So there's various types of comparisons that we are going to do. Now, with your project, primarily you are probably looking at this first one, because typically most students choose a company that they want, that they're real interested in, wanting to know more about that company. And so you're going to look at comparing the trends over time for that company as you do your project. There are limitations of financial statement analysis. So the accounting system does not measure all aspects of operating a business. So if there's a brand name, then that brand name has value. If there's a brand name that you are particularly, like Apple or something, that brand name has a value in and of itself. So, but that's not on the balance sheet. The value, it's like an asset for Apple, but it's not measured and it's not on the balance sheet. So the balance sheet is not telling us the whole picture. The problem is trying to measure that brand name is difficult and subjective, and we want things that are reliable, we said from chapter 2, to go on the balance sheet. So something like that is not on there, but that doesn't necessarily mean that it's a good thing. Okay, reported data is based on many estimates and approximations. We've learned in some of our senior accounting classes that this is so. The management has to make a lot of estimates, a lot of approximations, a lot of judgment calls. Okay, and even though there's certain limitations on how far out they can go, the GAAP covers, it's still lots of estimates are in there. The period of time covered by the financial statement is another consideration. So if you're only looking at General Motors for this year and last year, and we got COVID, how is that really going to give you a good picture of a long-term consideration? Okay, and so you may want to make sure that you look at more than just 1 and 2 years. Okay, comparing different companies can be difficult as well. Different companies use different methods of accounting. One uses FIFO and the other uses LIFO. They're both acceptable to GAAP. One uses straight line depreciation, another uses double declining balance depreciation. They're both acceptable to GAAP. So that can cause two companies that are basically the same to look a little different from each other. So you have to just keep that in mind. It doesn't mean that it causes massive differences, but it can cause some differences. We talked about the notes to the financial statements. The very first note is usually called like significant accounting policies or something like that. The very first note will tell you what methods of accounting for different things that company is using. Horizontal analysis, we saw in a previous PowerPoint how to do that. This is just a reiteration. You're comparing, horizontal means crossways, and you're comparing from one year to the next. And so for the same item in the financial statements, and it shows the total amount of change and plus the percentage change. The percentage change is the main thing that we tend to look at when we're doing comparative analysis, because it puts apples to apples and oranges to oranges. Okay? Especially if you're trying to compare a smaller company to a larger company. Okay, and of course we calculate that by taking the new number minus the old number. That's the total amount change, and dividing that by the old number, and that will give us the percentage change. Typically, if it's more than 10 or 12% change for something, we probably want to analyze that. And we would also, however, look at the total dollar amount. If it's real small, some small account, then even though the percentage might be high, we probably won't investigate that. Okay, so here's a fictitious company that we can take a look at. This is French Connection Importers, and this is their comparative income statement. And it's for 2 years, 2012 and 2011. The most current years, usually listed in the first column. So we took the new number, 2012, minus the old number, 2011, and got the change in total dollars. So the change in sales is $127,150. Then we took that change, divided it by the old number, just the 708,800 of 2011, and we got 17.9% change. So this is more than 10 or 12%, and so we would want to investigate it. Why did our sales go up so much? Okay, did we expand into a different area? Did we add a new product line? Did we do a whole bunch of different advertising? What caused our sales to go up? Okay, did we change our policies for who could buy on account, which customers could buy on account? If we loosen that policy up, we'll generally have more sales. Okay, so we need to investigate that. We need to have reasons for why that is. For your project, this would be talked about in the MD&A, the Management Discussion and Analysis, which is in the annual report. Cost of goods sold, if sales go up, typically the cost of goods sold is going to go up. But we would expect it to go up by the same amount. So if sales went up by roughly 18%, we'd expect cost of goods sold to go up roughly by 18%. But it didn't even go up by 16%. So somehow we were holding the cost of goods sold down so that, you know, it didn't go up by as much. That causes the gross profit, which of course is our sales minus our cost of goods sold, to skyrocket, 24% increase. Okay, so we would check out this cost of goods sold going up by, but not as much as we expected it to go up. That could be a good thing. Maybe we found some vendors that we could get our stuff from at a little bit cheaper price, but it's the same quality. But it could also mean a bad thing, like we found some cheap stuff that is not good quality, and that's how our cost of goods sold is smaller, but we still sold it for a higher price. Well, once customers see that they got cheap stuff for a high price, they don't come back to us, and we've lost customers for good. So that can be a bad thing. So we would definitely investigate that as well as the sales. Our operating expenses are our expenses from our office-related expenses, selling and administrative expenses, and that increased as well, which you would expect. If sales are going to go up, we got more customers, we need to spend more money on personnel, overtime and stuff to work on stuff in the office, and so we expect that to go up. But again, it didn't go up by 18%. We still managed to hold those costs down compared to the amount of sales. So our operating income, which is the gross profit minus the operating expenses, our operating income is a fabulous 36.6% increase. Now we have other revenue, and that's 425% increase. However, the dollars are very small compared to all these other dollars. So we would disregard other revenue. I'm not going to waste my time investigating other revenue. Okay, even though the percentage is high, the dollars are real low. You want the percentage to be at least 10 or 12%, and you want the